At your closing, there will be many documents for you to review and sign. This section is intended to introduce you to a few of those documents, so as to give you a better understanding of what you're reviewing and signing. It is meant only to introduce you to these documents. If you have any questions about any of these documents or others, your closing attorney is the best source for information. The first document that we will review is the HUD settlement statement. The settlement statement is an accounting statement that lists everything that was paid or will be paid by you or for you in connection to your real estate transaction, and every charge that will be applied against the credit of those items reflected as paid by or for you. We are going to focus on the left-hand side of the settlement statement, which is the summary of the borrower's transaction section. In this illustration, John and Jane Smith are refinancing their property. Line 103 shows the costs that are broken down into an itemized list from page 2 of the HUD settlement statement. In this case, the settlement charges will be $7,393.29. The closing attorney or settlement agent will go over these charges in their review of page 2 of the settlement. Line 104 shows the mortgage payoff amount of $410,132.92. This amount will pay off their existing mortgage on their property. This amount is often considerably higher than the principal balance reflected on your monthly mortgage statement due to the fact that the mortgage payments are always paying your interest in arrears, so that every day since your last mortgage payment was due, interest was accruing and being added to the principal balance. The settlement agent will take 1 or 2 days extra interest from the date that they are scheduled to disperse the payoff proceeds to ensure that enough interest is being taken to pay off the mortgage in full in light of the time added through the mailing process. Section 200 shows amounts paid by or on behalf of the borrower. This may include your new loan amount being borrowed, any deposit or earnest money, as well as any existing loans that may remain on your property. In our example, John and Jane Smith will be borrowing $409,000. This is listed on line 202 of the settlement statement. At the bottom of your HUD settlement statement are the totals listed. In this case, John and Jane have a total liability of $417,526.21, represented on line 301. This is the combination of their old mortgage listed on line 104 in the amount of $410,132.92, in addition to line 103, $7,393.29. Line 302 lists the new mortgage of $409,000. The difference between lines 301, their old mortgage and closing costs, and line 302, their new loan amount, is found on line 303 in the amount of $8,526.21. In our example, John and Jane will be bringing a bank check in the amount of $8,526.21 to the closing. In some cases, borrowers like John and Jane may borrow more money than they are paying off, and in that case, line 303 would list the amount of money that they would be getting back at the closing. The second page of the HUD settlement statement is a detailed, itemized list of all the charges relating to the transaction. In Section 800, you'll see items payable in connection with the loan, such as your appraisal fee, credit report, and other loan fees. Now, as seen here on line 803, the appraisal fee of $375 is listed as POC. This means that it was paid outside of closing and thus listed but not brought over into the accounting columns to the right. Sections 900 and 1000 list amounts to be paid in advance or deposited with the lender for taxes and insurances. In Section 1100 of your HUD settlement statement, all your title charges are listed. This includes the settlement closing fee and title insurance premium, as well as other fees associated with issuing the title. Section 1200 lists the government recording and transfer fees. These are paid to the state in order to properly record your documents. And finally, Section 1300 is used to add any additional settlement charges that don't fit into any of the previously listed sections. The top section of page 3 of the HUD is a breakdown comparison of your good faith estimate and your actual costs. Typically, the difference between your good faith estimate and your actual costs will be less than 10%. The second section of page 3 is a simple breakdown of your loan terms. The note is essentially a written, signed, unconditional promise to pay a certain amount of money on demand at a specified time. In our example, John and Jane have promised to pay $409,000 to the lender. The note also lists the interest rate, time and place of payments to be made, as well as the amount of each monthly payment to be made. The note also outlines the obligations that arise for the borrowers with regard to late payments and the transfer of the property or any beneficial interest in the property. The mortgage is a legal document by which the borrower transfers to the lender an interest in real estate to secure the repayment of a debt evidenced by the note. In essence, the mortgage gives collateral to the lender in exchange for the mortgage loan. When the debt is repaid, the mortgage is discharged, and a satisfaction of mortgage is recorded with the register or recorder of deeds in the county where the mortgage was recorded. There are 5 primary obligations in the mortgage. The borrower is required to pay their principal and interest and to pay it on time. They must maintain their property so that it does not deteriorate and lose market value, causing it to be worth less than the balance due on the note. The borrowers are required to keep up with their hazard insurance and taxes, either through escrow payments to the lender or on their own if they've arranged to do so with the lender in advance of the closing. If the loan commitment was for an owner-occupied loan, then the borrower must commit to living in the home for a certain number of months. And finally, the borrowers must agree that there will be no transfer of the property or any beneficial interest in the property without the express written consent of the lender. In our example, the borrowers, John and Jane Smith, are listed on the mortgage along with the lender. In this case, the lender is a member of MERS. MERS is an electronic registration system for lenders that simplifies the way mortgage ownership and servicing rights are originated, sold, and tracked. The next document we'll cover is the Truth in Lending Disclosure. This document requires lenders to fully disclose in writing the terms and conditions of the mortgage, including the annual percentage rate and other charges. The annual percentage rate is listed on the left. This is the yearly cost of the mortgage, including interest, mortgage insurance, and the origination fee, or points, expressed as a percentage. This is typically a little higher than the interest on your loan because of the combined fees. This document also explains whether or not the loan is assumable. It projects for the borrower the actual amount of interest they'll pay over the life of the loan if they keep the loan until its final due date. As most mortgages are insured by Fannie Mae or the Federal National Mortgage Association, there are some additional IRS forms which will be provided for signature at closing. The 2 most common forms a borrower might see at a closing are the Form W-9 and the Form 4506. The Form W-9 simply confirms your Social Security number. Now, you've probably executed this document before, as it is generally required by financial institutions when an account is opened. The financial institution is required by the IRS to keep a W-9 on file. The Form 4506 allows the lender or their assignees the ability to verify your tax returns. This is important for lenders in the event that there is ever a default, in that they would need to provide documentation to Fannie Mae that there was no fraud on their part in qualifying you for the loan. The other IRS-related forms seen at a closing are generally forms to be signed by the sellers in a property conveyance situation. Although it might seem odd, one of the common documents executed at the closing is an application to get the mortgage. Now, you likely executed one at the beginning of the process, but a final application is normally signed at the closing. As a borrower, you want to look this document over and make sure that you are properly identified. And if you're applying for joint credit, There is language at the top of the application that needs to be acknowledged by both borrowers, confirming that you each understand the rights and obligations of applying for credit with another person.